financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jay Dean, along with the Money Doctor, Francis Ram. Hello.
Well, hello, Jay. How are you?
Good, good. Beautiful day.
It's a beautiful day, and we have beautiful guests. So I'd like to welcome back, because they've been here once before, but never in a special edition like this. I'd like to welcome back Angela and Mike Tourville from Annie Mac Mortgage. So hello, guys.
Hello, guys.
Hello. Thanks for having us.
Thanks for having. Yeah,
You're
always glad to be
welcome.
back. Yeah,
You're welcome. So let me just give you a brief little background on each of them. Angela is a seasoned mortgage professional, and she's built a reputation as being a lifelong mortgage advisor. In no small part, because she has built a team of experts who support someone through the entire mortgage process. She's not just there when you write your app, you close your loan, you're done. Okay. Mike brings with him, a lot of experience in this industry as well, a deep understanding of the industry, an extensive mortgage lending experience, and he's actively involved in things like community outreach and financial education initiatives, which is how our paths crossed initially. We want people to be smarter about money, and one of the biggest purchases you will ever make is real estate. Welcome back to both of you. Could I start by asking, whichever one of you would like to answer, or both, what about this crazy mortgage market right now? Quick little background in March, right? In March, we had resale housing slump. We had new housing spike. Okay. Who wants to start?
Angela, you're deeper into it, so I would defer to you on this one. How's that?
Sure. It's super hyper local. One neighborhood to the next is complete different ballparks. Then you get the strategies of realtors, maybe underlisting homes and creating a ton of attention. Quick little story. I was on a walk with a pretty high producing listing agent this morning in our area, Hampden County. And she was saying how, she was attracting 30 to 40 people in one day through an open house, but she was only receiving 3 or 4 offers. And in my opinion, and I did have a buyer that was had an offer in on that home, and my buying agent thought that it was underpriced. So I just think that the consumers are a little bit hesitant and scared because they're realizing it's a very big commitment, right? Mm-hmm. And the uncertainty with the economy. So the commitment, they want to make sure it's the right one.
Right.
And so I think the buyers are being a little more particular. And people have been promising rate declines, and we're just not there, right? So
those people
6% fixed now. Is that what it is?
What headline are you reading?
I've got averages about 6.83% average right now.
Probably more like it. Like it. Yeah.
Yeah. And I think, Angela, you're right. But think about this. It's compounded with all the other external stresses, right? The stock market's volatile, the tariff situation, the employment market. Lots of people that I've speaking to recently are a little nervous. So I might lose my job. There's things that are unstable. There's a lot of uncertainty that compounds, obviously, their stress, and it translates into the real estate market. So you've got many things happening that are unusual all at the same time. And it's unpredictable right now. I mean, you can listen to the experts and they contradict each other, and
yes,
it's hard to say where we're going.
Yeah, that's true. I think, with the resale market slowing down in March, I think it slumped to 5.9%, which was the worst monthly decline since 2022, I think. But the new home sales spiked up, right? They surged to 7.4%, I think. based on what I'm reading, is builder incentives and more affordable housing options, right? So more affordable housing options is probably in your camp because you do lots of things, especially for first-time home buyers, to make things easier for them. Can you talk a little bit about what Annie Mac Mortgage does and what you do through the Momentum Group and through your own skills to help somebody get into a home that maybe thought they couldn't afford it?
Mm. Well, we can definitely help with the competition, right? But you're leading into a question, which is a big question I ask in my consultations, because what I can compute someone to afford is not necessarily what they can afford.
Uh-huh.
And so one of the biggest questions I ask in my, because we always do an initial consult to get, goal gathering and situation, because this is a very situational transaction, right? It's specialized to, or actually personalized to that individual. And the big question is, what is your ideal mortgage payment?
Mm.
And that's where the power lies. I don't think it lies in the purchase price because I can craft a mortgage around that ideal payment and the
Right.
assets that we're willing to let go of or the assets we want to retain. And so everyone's very focused on, and I might be getting off your actual question at this point,
No,
but
this is perfect.
they're
Yep.
very focused on purchase price because there's a lot of outside noise. And I won't say what roles in the real estate team have that noise, but they push to purchase price.
Right.
And so when I'm dealing with a client to give them that power and confidence when they're in the market is knowing their box. And that starts with the ideal payment.
Mhm.
And so from there, we can take it wherever we need to take it. But at the end of the day, they can be confident and aggressive and compete within their means. So when they go to bed at night, if they won that offer or if they didn't, they're satisfied still.
Yeah. So I love it when I ask someone a question that takes them a second to think about it because it means we're digging in a little deeper than somebody might
Yeah.
on a typical show. So yeah, I think all of that is true. How people decide what they can afford for a mortgage is a complete show all of its own, right? But
Mm.
but let's suppose that they decide this is what we can afford. And because they've maybe been to another bank somewhere or another lender, or they just looked it up on the internet and said, here's what my mortgage payment is. They've seen that means you can afford a $175,000 house. And they say, oh, I can't find anything for $175,000. One of the things I notice, I'm wondering if you notice the same thing, that people forget about. Maybe I should ask you, what do you think people forget about? What don't they know about a mortgage if they're a first-time home buyer? What do they not know that you wish they knew?
Can I just say something real quick before
Yeah.
Angela? Because I'll give her more time to
It's a
think
big
about that.
question. Yeah.
And the thing is, we always stress, and I encourage people. There's two things: one, education and preparation. Okay, but early as possible, as advanced as early on in the process, because what happens sometimes it's a Chinese fire drill. We
Yeah.
found a house over the weekend and we need you to qualify us by 2 o'clock. Wait, what? And you've got puzzle pieces of income that you have to figure out, and it's all done in a rush. And then there's things that they didn't, and they waste a lot of people's time sometimes when you find these gaps or qualifying criteria that needs longer explanations or research to figure that out. So the earlier, the better, the more education and preparation the better. So you can avoid those last minute Chinese fire drills. I know Angela encounters that a lot. So what we would say when you're saying, okay, I'm going to start looking for a house, pause, consult. And I know Angela, when you were speaking earlier, you used the word consult a few times because that's what you have to do early on to position somebody early so they're not going through all the motions with no result. Anyway, that's now that you have time to think about your better answer.
Um, Actually, I'm going to jump in the middle, Angela.
Yeah.
I'm going to give you just a second more and
Yeah.
say, Mike is spot on here. What I find people do, what they think the housing purchase market is I go online or I figure out how much money I think I can afford. I calculate by some quick method how much house I can buy, or I get pre-approved for how much house I can buy, and I go and I shop. And because I'm shopping for a $300,000 house, because that's what I'm approved for, guess what I end up finding? A $350,000 house. And what does pre-approved mean anyway, right? So people are making these giant decisions about getting a mortgage, something they are going to partner with the rest of their adult life, or in our case, much shorter, but still many years, right? Without really giving it its due diligence and learning up front what you're going to do, how you prepare for this sort of thing. I mean, absolutely. All right, Angela, back to you for your question.
Well,
Your
my
answer.
brain went to a million different things of what I want them to know after all that.
Great. Okay, good.
One thing there's a lot to know. And again, I think it comes back to situational. It's situational. It always is, right? There's all kinds of factors. What I try to provide and what I want them to buy into when they work with me is trust. I want them to trust that I'm not going to make, number one, a decision for them, but I'm going to give them everything they need to make it on their own.
Yes.
And as far as affordability, that is, I've seen the average income of, $75,000 being able to get into a $350,000 home turn into now 120,000. The median incomes are they're not increasing, but the affordability on them are as far as to get in. So it comes back to developing resources. What resources do you have that you don't know you have? And Fran, you might not like this one, but I go, hey, you have a 401k.
Oh,
you might have a family member. And quite honestly, most people don't realize, and I have to assure them because I have the bird's eye view. They have their own bubble that they're looking in. And I have to assure a lot of first-time home buyers, 60% of the time right now, parents are helping them get into the home. They're helping with the assets.
Yeah.
It's a big thing going on right now.
I'm sorry, Angela, you're right. It's not that I don't like it because it's your money. I don't like doing it the wrong way. I don't like them taking a withdrawal out and getting whacked 20% penalty because they're under 59 and a half. And I mean, a 10% penalty and 20% on taxes, but you can borrow against your 401k and pay yourself back. That's one way to possibly do it. I try to help people conserve their dollars as much as possible because that $20,000, $30,000 that they might be wanting to borrow against their 401k to help them with a down payment might turn into, $100 a month in a payment over the course of time. And they can more easily tolerate the $100 a month and leave the money in the market where they can grow it for their retirement someday, especially if they apply something like our system that pays the debt off quickly, including the mortgage, right? But I tend to look at it from an advisory standpoint like that. Like, yes, I want you to get into a home. That's what money is for you to achieve your lifestyle goals. But I want you to do it the smartest way possible financially. Where I was headed, and folks, if you're listening to this, you can tell that this is why Mike and Angela and I are talking, and I'm not talking to a big box bank VP, because these folks think like this about your mortgage. Okay, they actually care whether you're going to be able to afford to have this house or not, in part because of their in-house program, which we can talk about because that's part of what makes them a different lender, makes Annie Mac a different lender. But where I was headed with that, I almost forget now. I did forget. Where was I headed?
I think I know where you were headed, how we can give an edge to our clients.
No, it's just before that, talking about finances and well, it doesn't matter. Anyway, I'll pick it up from there and edit it out. Yeah. But anyway, they actually, if they actually care about what happens for you, the one thing that I was hoping Angela would say, but she's got so many things she wants people to know and remember when they're getting a mortgage. For first-time home buyers, and maybe even people who have already owned a home and are looking again, they forget taxes and insurance. They go and pre-qualify for how much house they can afford based on a principal and interest payment. And taxes and insurance change your life. So you got to go talk to professionals like this before you put your offer in on your house, before you go shopping, and find out what a real pre-approval, and that is not an approval, but what a real pre-approval means. So Mike, this might be a good question for you, even though I know Angela has the answer too. But in terms of education, what's available at Annie Mac to get people to understand this stuff before they get themselves in trouble?
Well, there's a lot, and there's so many things that now I forgot what I was going to say. See, it's contagious, isn't it? But
Good.
um, but one of the things is you say, look, it is. You look at, you said taxes and insurance. When's the last time your property taxes decreased?
Right.
When's the last time your insurance decreased? Okay. Now your mortgage principal and interest payment may stay the same for the duration of the loan, but there's a strong likelihood both your taxes and insurance are going to increase over time. So you have to think about that, not just the amount, but they're likely to go up and increase your mortgage payment all in.
That's right.
So that's always something to consider too. I'm glad you brought that up. And the other thing too is we encourage our borrowers to seek advice from a financial advisor, because some of the things you mentioned, if they're going to put 20% down and they say, I'm going to put 20% down and get 6.8 with no points, perfect. They've decided that at their kitchen table and they think, well, that's what Angela presented. Well, that's what my loan officer said. So that's what I'm going to do. Well, why don't we pause and think? Because does it really make sense to use an asset to put 20% down? Maybe there's some other consideration to put less down, reserve the assets, and your monthly payment might be adjusted by just so much. Yeah, what about paying 1 point or 2 points to change your rate? And
Right.
we have a program, and Angela uses it often, and every borrower called Mortgage Coach, where we compare paying a point or two, paying 10% down versus 20% down, how that affects your PMI. So the point is, it's a big picture where having some professional advice can help you say, here's how this is going to impact your assets, your 401k, your cash flow. And to look at that whole picture from an outside third party is, we encourage that because it's very helpful, because that's when people have the aha moment, go, oh, I didn't think of that. I didn't think that was an option. So we try to encourage people to do that and present them with those choices. So in the end, nobody's going to second guess and say, oh gosh, I wish we had known this.
Yes.
So
Well, you brought up another perfect point of things that people don't think about. They don't think about PMI. For those of you who don't own homes with PMI, that's private mortgage insurance.
yeah.
I call it throwing money out the window, but that's what I get to say from my side of the desk.
I agree with that.
I thought you might,
Yeah.
Jay.
I just say thank you for, paying some insurance for the lender, because in the end,
Yeah,
that's what it is.
exactly.
Yeah.
Oh boy, I have a great question for you sometime, but it's going to drag us way into another topic. But remind me to
Okay.
ask you about PMI and the housing bubble. That would be fun. But Jay, I thought you might agree with that because, private mortgage insurance you pay because you have less than 20%, and you guys can correct me if I'm wrong, of course, less than 20% equity in your home, right? Some mortgage clauses say you have to have 20% equity or you have to have paid in for 2 years before you can try to get rid of your private mortgage insurance. Okay. Private mortgage insurance is going to cost you X number of dollars a month. It's insurance. What you're doing is insuring the lender in case you default on your loan. That can be hundreds of dollars a month for people, which could make the difference if you have a creative lender like Angela or like Mike, right? It could make the difference between how much house you can afford and how much house you can't afford because you had PMI. And there are ways to get around it. There are creative ways to get around PMI if it's the right thing for you to do and if the numbers come out right. But Mike is correct. You need to zoom out and look at the big picture. And I'm going to just step in here and say, yes, ask your financial advisor. But get your antennas up because not all financial advisors will either know this stuff or care, or they would prefer to keep your money in the market for some reason that maybe doesn't have much to do with you buying your house. I'm not suggesting nefarious means. I'm just saying they may have a different vision than you have. So you got to get somebody who's going to come to the table with your mortgage brokers or mortgage lenders, excuse me, and say, I like where you're headed. Like I've seen the software that Angela uses. It's very good. It gives you a really good comparison about how to do this well. And she uses it, I think, almost on every deal, right? And so you get a lot of, you get a lot of material there, a lot of input that you might not get at a typical lender. And this is a good time for me to say, I don't make any money on this. I'm not affiliated with Annie Mac. I don't get any overrides. This is it.
Yeah.
I just happen to like their model, and I wanted to
Yeah.
have them on again.
Can we get the phone number, Francis, from you for people?
Of course, they can reach us at 413-773-3333.
Of course, as always, you can go to hugyourmoney.com. And we will be back with more Financial Fitness with the Money Doctor, Francis Ram, coming right up. This is Financial Fitness with the Money Doctor, Francis Ram, on WHMP.
Financial Fitness with the Money Doctor is underwritten by Franklin County Technical School. We build futures. Visit fcts.us or call 413-863-9561.
Welcome back to Financial Fitness. I'm Jay Dean, along with the Money Doctor, Francis Ram, and the Tourvilles. Very happy to have you here. Great stuff. Great stuff.
Thanks, Jay.
Can
Yeah.
I throw a couple things in real quick? My wife and I got our house in 95, had it built. Thank goodness it's paid off. And we were talking before the break about PMI. And I thought, and maybe you guys could answer this question for me, because I always want to know the answer. It did not drop off after our levels got to that certain point. Was that because that law didn't go into effect until after 95? I was asked to jump through hoops. Oh, you need a comparison. You need this. You need
You need an
that.
appraisal or
And
enough
I asked,
equity.
I said, no, they said they had already done an appraisal. I said, send it to me. They sent me the original comparative before the house was built.
No,
And
you got to prove that you've paid your loan down by that amount, or you get an appraisal that shows you have that much equity in the house. Angela
Yeah.
and Mike may have a different slant because their fingers right on the pulse, but what say you?
Well, one of the things that kicks in, and then Angela can elaborate on this, is when your loan value reaches 78% or lower, it should come off. But the obvious thing is, who's going to know? How are you going to convey that to your lender to say now it's time? Because they're not looking out for you. We are, but so that's one thing. Angela, you can elaborate on that.
yeah, I mean, what you said, Jay, is they're going to go off original value.
Hmm.
So they do make you jump through some hoops. And what's happening right now with the appreciation we've seen since COVID is a lot of people are at that loan to value percentage before 2 years.
Mhm.
And so they're thinking they can drop it. So with my servicer, if I log into my mortgage application, it'll tell me how many years are left until I reach that percentage. If I want to drop it before then, yes, I have to prove the value, and typically with an appraisal, and then they have to agree upon it, and they charge a fee to do it.
Mhm.
Now, if you're paying $150, $250 a month in PMI, it's worth the $500 fee and $600 for the appraisal, in my opinion.
Right.
Some programs are PMI for life, though.
Like
And those
an
are
FHA loan.
your
Yeah.
FHA loan is PMI for life. So you have to
Well,
actually get out
yeah.
of the loan to drop that. So that you can, let me go back a little bit though. If you put 10% down or more with an FHA loan, it will actually fall off, but typically people aren't doing that in that
We put
lending
down
environment.
5, as I recall. 5%.
Yeah, typical. Yeah, that's a typical down payment. But there's more ways to pay your PMI than monthly. And that's when we get into strategy. That's
Okay.
when we get into strategy.
I love that word strategy. All right, tell us, Angela.
Oh, okay. Well, it sort of goes hand in hand with the high interest rate environment we're in. So with the presentation that we use, a lot of people are still conditioned that 20% down is what you need to do to get into a house. And this is where a lot of people say, I'll never do it. And that's true, right? So, but they'll come to the table with 20% down. And sometimes what I'll show them is the 20% down that they wanted to put. And then maybe I'll show them 18% down and buying out their PMI for a small fee and using the additional funds out of that 2% we saved to permanently buy down their interest rate. So now they're netting the same cash out, but their monthly payment could have been saved almost $300 a month, spending the same amount of money, which in turn could increase their purchase power too, which would allow them to be maybe pre-approved up to 400
Right.
But look at those $300,000 homes and leave that wiggle room for bidding and competition. So really hard to understand that though if you can't see it. So that's why we consult visually.
Yeah, that's a great point. I was going to mention that earlier. There's choices to pay it up front or a combination upfront and monthly. Certain loan programs will allow that. And if you're strong on your assets, but weak on the debt ratio and payment, this might be an option to solve that, and vice versa. So when we spoke earlier, and Angela's saying, look, when you talk about creative ways, and I bet you, I know a lot of loan officers, lenders won't offer this or think about it. And a lot of borrowers then therefore don't know about it. And that's what I was saying earlier. Later on, when you learn these things after the fact, you start, gee, I could have done that. Had I known, it would have made more sense. So
I have
It's
a
always
really
that-
cool, oh, sorry.
No, go ahead, Angela.
yeah.
There's another really cool insight. Most lender, just speaking of lazy
Yes.
lenders.
Yeah. Okay.
With the new pricing adjustments that we've had over the last couple of years, you're going to get a better interest rate at 5% down than 10.
Really?
How does that work? Yeah.
Well, there's
Yeah.
price adjustments based on
Yeah.
loan to
Yeah.
values and credit
Right.
score. So back in the day when Mike was writing loans left and right, and I was probably in middle school still, he had to manually calculate his interest rate. Now we have technology, but if you know the behind that technology, as a lender, yeah, I know they want to put the higher down payment, but if we put the lower down payment, maybe we buy out the MI, and maybe we can take that chunk and do what's called a recast after we close. Now we ended up with the lower rate, no PMI, even though we did a low down payment, and a recast is almost the same as putting that money down when you purchased, but doing it on the back end. So you end up with the best of all the worlds.
Yeah. And explain what recast means, because it doesn't come up that often,
It
Angela.
doesn't. It's such
That's
a
right.
great strategy.
Yeah.
To all the equity out there. So recasting is when you have a lump sum payment, and you want to put it down on your mortgage balance. If you were to just make the payment, down on the balance and lower your balance, your payment does not recalculate.
That's right.
A recast is recalculating your payment based on that new balance over the remaining term of the loan that you have.
Yep.
Some would call that sounds like a refinance. Well, guess what? It's not, because we're not refinancing your loans. You get the same terms. You're
Right.
just recalculating the balance for a nominal fee, maybe $300 to $700 to get that done. So that's another strong strategy.
It's brilliant to say to recast up front like this as one of your strategies. I didn't know you did that, but it's brilliant.
yeah.
I love it. Then we're such geeks, right? We're such
I know.
financial geeks. We're like
it just
getting all
it
excited
works.
about this stuff.
I know.
But that's a real strategy that you would not know. I promise you, you walk into any big box bank, somebody call me. If you walked into a big box bank and said something like this and they had even any idea what you're talking about, never mind that they proactively tell you, hey, here's a way to get you into this house. I just want to thank Angela and Mike Tourville again.
Thank you both.
For coming on from Annie Mac Mortgage, and mention that they're part of the Momentum Group.
Francis, can you give the phone number again if people have questions for you?
Sure, of course, Jay. They can reach us at 413-773-3333.
Or as always, go to hugyourmoney.com. Angela and Mike, thank you very much. This is Financial Fitness on WHMP.
Financial literacy and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jay Dean, along with the Money Doctor, Francis Ram. Hello.
Well, hello, Jay. How are you?
Good, good.
I'd like to welcome back Angela and Mike Tourville from Annie Mac Mortgage. So hello, guys.
Hello, guys.
Hello, thanks for
Hello,
having us.
thanks for having. Yeah,
You're
always glad to be
welcome.
back. Yep.
You're welcome. So let me just give you a brief little background on each of them. Angela is a seasoned mortgage professional, and she's built a reputation as being a lifelong mortgage advisor. In no small part because she has built a team of experts who support someone through the entire mortgage process. She's not just there when you write your app, you close your loan, you're done. Okay. Mike brings with him,
Right.
a lot of experience in this industry as well, a deep understanding of the industry, an extensive mortgage lending experience, and he's actively involved in things like community outreach and financial education initiatives, which is how our paths crossed initially. We want people to be smarter about money, and one of the biggest purchases you will ever make is real estate. Creative solutions. Let's talk about some other creative solutions. A simple one, right? That because obviously you're giving away the keys to the kingdom here, and I want
No
people
gatekeeping. No
I
gatekeeping.
want people to come and talk to you about it. And we have the same idea. If you tell people the truth and you explain things, they understand you're knowledgeable, they will work with you. But creative solutions, let's talk about buy downs and seller credits. Buy downs, points. Can
Which
you
is
explain?
effectively prepaid interest, and that's all it is. So, yeah.
Yes, explain to the layman.
Well, points, they could be used for so many reasons. One, if you certainly want to pay a discount point to lower your interest rate, that could help you to qualify. There's one simple reason to say, hey, we lowered your interest rate by having a discount point. And if the seller, you talked about seller credits towards a purchase, sometimes the seller will credit an amount towards the closing cost, and they could go towards discount points if all the money adds up enough. There may be reasons to pay points because, well, you got to look at the bigger picture too. What's the payback? I'm going to pay a lower interest rate because I paid some money up front. How long will it take me to break even? And do I expect to be in the house for that period of time? Is there anything that's going to change in that period of time that I'm going to refinance and purchase? Not everybody knows the answer to that, but if you can think about it, yeah, I'm going to be in this house for 10, 15 years. It may make sense for you to pay a couple points and lower that interest rate because you're paying now to save later and save more on a longer term. If that's not your story, then I wouldn't pay points. In fact, you would pay 0 points. But if you say, I'm going to be in this house for 2 or 3 years, if the payback typically is 48 to 60 months, 4 to 6 years, call it 5.
Right.
That's the benchmark you got to think about. And that's one basic thing to think about when considering points. Simple math, right? 1 point is 1% percentage of the loan. And that 1 point paid up front typically reduces your interest rate by about 1/4%. Is that right, Angela? Ballpark?
It's a mad science.
It
Right,
depends
but
on the
it's
rate,
typically-
right? Yeah, yeah.
There's a lot of background on what
Yep.
it computes to interest rate discount wise.
Yeah, you can pay partial points too, if it makes sense financially. And I know that's where Angela comes in to do the math and find the optimal level.
Yeah.
And by the way, the typical life of a mortgage is, call it 5 years. The lenders didn't come up with a break even at 5 years by mistake.
That's right. Yep.
So
Yeah, that doesn't mean that people's mortgages last 5 years, folks. It means that in 5 years, somebody's doing something. They're selling their house, they're refining it.
Exactly.
Something is
Yeah.
happening to that loan.
Right.
At Hug Your Money, we like to have everybody out of all their debt, including their mortgage, in 9 years or less. So a lot of times we won't move that loan because by the 5-year mark, it's we're blowing principal onto it, right? So it
Yeah.
doesn't come into effect. What about seller credits? Angela, do you deal much with seller credits?
I try to avoid requiring it.
Right.
I'll say it that way. I would always recommend seeing if you can incorporate seller credits. There are stipulations on what you can receive based on your financing and your down payment from a seller. So there are caps on what they can give. Typically, people are using that to help with their costs of the loan, and points can be part of those costs. So we could strategize doing a permanent interest rate buy down, purchasing discount points. The other strategy, if you want me to get into it, is called a
Sure.
temporary buy down.
Okay.
And now typically not every lender actually offers temporary buy downs, and they only allow sellers to pay for this. What a temporary buy down is we'll call it a 3-2-1 buy down. So the seller is in essence prepaying the first 2 years of interest for you to buy down your interest rate. So here's the scenario. The rate today is 6%, and you're using your seller credit to temporarily buy down your rate for the first 3 years. So the first year is 4% is what your payment will be based on. The second year would be 5%. And the third year being that par rate that you took at purchase at 6%. Now it's fixed. So it's a fixed interest rate that temporary eases, starts lower and goes up over that course of time. That's a great strategy for someone who might be, holding their breath on a refinance opportunity, or possibly looking to maybe get out of that loan one way or another in a small window of time, instead of taking on an adjustable rate mortgage. Most adjustable rate mortgages require a 10% down payment or more. So you can get into this very low interest rate environment the first 2 to 3 years, or first 2 years really usually, with the seller's money, and make out very, very well. It's a great strategy.
Why would a seller do this? For somebody who's just listening to us talking about numbers and they're saying, yeah, that sounds great and interesting, but I don't understand what you're talking about. Why would I be able to use a seller's money to do this?
Well, for a seller, their perspective is net earnings. They're looking for a net amount. They want to walk away with something particular, right? So there's a play on words here that happens a lot, where someone else besides me advising a client to roll into their loan their costs. You can't roll in your costs to your loan. What you do is you offer a higher purchase price to buffer in the credit you're asking from the seller. That's one way to obtain funds from a seller in this competitive market that we're in. Another way that people tend to obtain seller credits are through their inspections. They do not waive their inspections. I don't get involved in inspections as a lender. I don't need to know, but there could be something that comes up in those inspections that you're able to renegotiate the terms of your contract. And those are typically the two ways right now over the last few years that I see sellers actually contributing towards buyers' costs. Now it's up to the buyer and their advisor, their mortgage advisor, if they have one, to find out the best use of that money.
One of the strategies that I've used with clients over the years, and it's along the same lines as this, it all sounds like gobbledygook to somebody who isn't in finance. You don't have to learn everything about what we're saying. What you have to learn how to do is choose somebody who knows what they're talking about and work with them. That's your job. Choose your teacher, okay? So you learn how to learn. That's just a tiny little example of how you can get into a house creatively. We could talk forever about how to creatively do a deal, but when it comes to the lending part, Annie Mac is a direct lender, right? So a direct lender with in-house processing, underwriting, closing, that makes for a smoother and faster deal. Am I right about that, folks?
The only reason I work here.
Okay.
The only reason?
Well, not the only reason. A big reason why I'm in retail lending and not brokering.
Can you contrast that to what somebody might experience at another kind of a lending institution?
Well, the speed factor, the team that they get, it's not different every time they pick up the phone and call. You're getting the same 3 to 4 people throughout the whole transaction. We're guiding you. You're getting the same underwriter the whole time. And so what we do here as a no matter what, there is an underwrite happening with your pre-approval. A true pre-approval is an underwritten application. So I usually say this, and not to get off topic, but I'm a loan officer that Annie Mac trusts to do my due diligence properly to make sure when I put my name and their name on that pre-approval letter, we're going to be able to execute that for you.
You are listening to Financial Fitness with the Money Doctor, Francis Ram, and we'll be right back. This is Financial Fitness on WHMP.
Financial Fitness with the Money Doctor is underwritten by Franklin County Technical School. We build futures. Visit fcts.us or call 413-863-9561.
Welcome back to Financial Fitness with the Money Doctor, Francis Ram. Let's pick up where we left off, Angela.
So, my Annie Mac's giving me the authority to do my due diligence and pre-approve you properly. So we're executing this for you, and you're closing smoothly. But not every lender is giving out those quality pre-approvals. We are providing a fully underwritten file when you're shopping. That's a no matter what. So the underwriter I call is the gatekeeper. They say you get your money or you don't.
Mm-hmm.
And basically they say, prove it. Prove what you told Angela to me. That's what's really happening behind the scenes. So when you're shopping, once you're approved, you're going to have that same underwriter that already developed your file see you to closing. So the likelihood of, because underwriting sometimes is very discretionary. Yes, there's guidelines, but they have the authority of our money to lend. So there's discretion in that. So when you have the same players all the way through, they're not going to change their mind typically. Whereas when you're in another environment and multiple underwriters are looking at things, you can have a set level of conditions. Someone else jumps into the pot. Now we have 5 more things we need because of their opinion. So with everything being in-house and us being team oriented from start to finish, you have exactly the same people and you have access to us all. And we all work together for you. So it's a very smooth experience.
Yeah, I'll agree to that because I used to be a broker many years ago, and there's a disconnect, a communication disconnect. And when you try to set expectations, and this one thing I'm big on, setting the right expectations for people. So when something happens, I said, you said this might happen. Oh, it did. So let's go. But it's a minefield out there with brokers, with being when you're broker, because there's all kinds of things, guideline interpretation, various guidelines, and different people and communication and disconnects. It's tough to keep up, but I agree with Angela because just the mere consistency and reliability with a direct lender and Angela and her team makes all the difference in the world.
I want to agree with Mike on that and say, without embarrassing Mike, that he and I are both older than Angela. And what Angela just described feels a little bit like it used to be, where you went to a bank and you said, I would like a mortgage. And they actually looked at you and talked to you and pulled your credit and read it. They didn't just say, here's your number. They actually read your credit. Being able to work with the same team all the way through, I think must be very comforting. And for a first-time home buyer in particular, that's what I would want for them. I want them to be in the safest, most confident hands they can be in. I do want to ask you though, Angela, you're wearing this shirt that says, don't just bid, win. Yes, don't just bid, win. What's that about? Can you tell us?
So very unique to Annie Mac. Not only are we getting you pre-underwritten, but we've established ownership of a private equity firm called Cash to Keys. So it's very competitive out there and cash is king, right? Yeah. So we realized that. So we're putting cash in front of our buyers' financing when they're offering on properties. So we're guaranteeing to a seller on a no matter what, you're closing on this closing date in your contract. There's no extensions allowed. This is going to happen and this will execute. And we follow through. So
people just heard the needle on the record, like, you're putting cash in front of, you're putting cash. Does that bear repeating?
Say that out loud. Yeah.
You're putting cash in front of your buyers. Yes. So let's get human about this for a second. Very competitive market. You have the same bid on a house as somebody else has. They're saying, I'm going to pay you cash. And you're saying, I'm going to have to go get a loan. Which one do you think the seller wants? So by putting cash, by Annie Mac putting their cash on the line in front of your deal, you are going to be more competitive. If I'm right, can you explain that?
Absolutely. I mean, I have so many stories in such a short window of time of my clients winning. Great. And so let me just use a VA loan for an example. Okay.
Yeah, give us one story that comes to mind. Angela.
Oh, this story is so good. So I'm working with a military family who's disconnected because of travel and recruitments, and they're trying to bring the family back together. And we get them. First step is always pre-approval, and they're shopping with their VA offer. So what a seller is seeing is a VA loan, government loan, who will have some property standards to be met and 0% down. And they're against offers that might say no property standard conventional financing with 20% down.
Right.
As a seller, it's not always the price of the house and the net, it's the execution of actually it finishing and getting
Right.
across the finish line.
Right.
And another offer a lot of people have in is maybe a very strong offer with a large down payment, maybe 50% down, but they're contingent on selling a property they currently own to fulfill that.
Mm-hmm.
So with this VA story, they were getting rejected left and right. There's a bad stigma on VA financing because they feel people putting 0 down should not even be shopping for a home. But what they don't realize, it's an entitlement that was earned.
That's right.
So this particular family, we were able to get them approved with our cash equity firm that we own. And now they're putting cash offers in. So they were rejected about 4 times. And one time with no other offers on the table, and the realtor feedback was, it's a VA loan, no thanks.
Wow.
Which is illegal, but that was
Yeah.
what was said.
Yeah.
And so, not only do we have a military family who's displaced, very high emotional transaction, and they're getting rejected, and they just want to wife and husband come back together with the kids.
Yeah.
We approve them the cash to keys. They put a cash offer in on a home, accepted. Right? Rightfully so.
Yep.
It would be. We closed their loan in 3 weeks, and they received money back at closing.
Yay.
So, I mean, it was just, and they're beautiful clients of mine, and we're going to be connected forever.
Yeah.
And so that's a small story, small sample size of that.
And it's
one
important to add to
particular.
that. It's important to add to that in the end did not cost them anything.
Right.
Yeah.
This is a way for Annie Mac is, and there's so many more things that are coming down the line. We want to serve the community, and in a business mindset, we want market share. We want to dominate. We have some very high caliber loan officers that are working for us here at Momentum, and we're not playing around. We want to win.
Yeah.
And we want you to win. And so Annie Mac and the owner has put together these amazing strategies that people are trying to chase our tail feathers on some of these because they're seeing the market share being taken. And it feels really good. It feels really good to be a lender with great strategies, still providing amazing mortgage opportunities that are crafted to a person's situation, and helping them win with cash. It's a dream come true for a lender, quite honestly.
It's sort of mind-blowing for anybody like me that, anybody who's been following what we do for the last 17 years will know I won't put a guest on as a sales pitch. I just won't do it. You can't buy your way on my show, right? But you're busting a lot of the myths, like you have to have 20% down to buy a house, or you can get pre-approved and then go shopping and it's all going to work out fine. You're saving people from some disappointments. I mean, let's face it, everybody who wants to buy a home falls in love with the home, right? Even if it's an investment property, you get really excited about how much money you're going to make on that investment property. So it's very disappointing if you go through all this time, you jump through all these hoops, and then you get right to the point of a closing table, or the end of the loan, and oh, gee, it fell apart because somebody didn't do their job upline of you. Somebody didn't see, you told them all the truth. Hey, I told them what I made. They said I was pre-approved. How come now I can't get the loan? So I really appreciated that you folks were so upfront about this. And I just wanted to say how rare that seems to me. And why we've become, closer and talk more often about these kinds of things, because I get courted all the time from mortgage brokers and mortgage lenders. They want to come on and pitch whatever they've got. And it's always something like, well, we have a great new interest rate on a loan. I'm sorry, but you got to do more than that to impress me. I can find that on
Dime a
the
dozen.
internet. Yeah.
Yeah.
So I mentioned credit. I wonder if either one of you would like to, or both of you would like to take a crack at this. What do you wish people knew about their credit, or what do you do to help them prepare their credit? ahead of getting a loan application in?
I'll start with a simple thing, and Angela, dive a little deeper. I think going back to what I said, the earlier you can be educated or prepared. So the soonest you can look at your credit and recognize or identify things that might surprise you. And the earlier you can rectify those surprises, the better, right? Because the last thing you want to do is be chasing some old judgment or some old bill that didn't get recorded right. And that's a pain in the neck, right? To have to do that. So looking at that and understanding what steps you can take to improve your credit score. Some simple, some take some time, but knowing that up front, because guidelines are based on minimal credit scores and tiers. And if you're just a couple points below that tier or above that tier, and you can get above that tier, that could perhaps improve your qualifying, criteria. It can improve your interest rate. There's lots of things that might change if you get now, but if you asked anybody, what their credit score is off the top of their head. And by the way, would you know how that's going to affect your next mortgage? Nobody knows that because it's not a need to know that in everyday life, right? Until you're faced with it. But you have somebody with like for example, a 675 credit score, and they can take measures to get it to 690. Well, the criteria on that loan might be 680. And a little bit of work on that, a little bit of consulting on that might get them over that hump. That's just one example. But my point is know your credit as early as possible, so you can know exactly what to do about it if you need to.
So are you saying that if somebody has been turned down many times for a mortgage, that they could come to you and learn what they could do to turn that around and maybe be approved in the future?
In some cases, yeah. I mean, because again, some of the things that there's so many factors that come into credit, how many inquiries you have, and
Yeah, I mean, they have to do the work.
they have to do the work, but there's lots of factors that affect your score.
Thank you. I can't believe we're almost out of time here, but I do want to ask you one question. For both of you, how do you balance being educators and lenders? Where do you find it difficult to balance that, if anywhere?
I don't find it difficult. It's part of the experience.
Yeah.
It's just completely part of it. I'm not the decision maker.
Mm-hmm.
I'm not making the decision for the client. I'm giving them what they need to make it.
Yeah.
And at that point, it makes the lending piece of this very easy. I can write a loan in my sleep. That's the easy part. The challenging is more around managing the day and the workload and the conversations and the consulting and providing the value with high volume. That's more of the challenge. But the experience is the education. That's what it is.
That's fair enough. Fair enough. So, Mike, do you have anything to add to that?
No, I agree with her because it's got to be. I mean, so many borrowers that we speak with, when you talk about this, say, "Oh, I love when people say, I didn't know that. Oh, I wasn't aware of that." And I feel, oh, good. There's something we set them straight on. So it's just nice to hear that back from borrowers.
That's great. So I would say that whether you're trying to navigate this mortgage market in this climate, or you just want to be smarter about your finances, I hope you got something out of this show. And I'd like to give Jay Dean the last word. Jay, do you have anything to add?
Well, no, the only thing was that without sounding like the old man saying, "Get off my lawn," I mean, back in the day, I bought myself an amortization book. And I understood that I couldn't have more than 25% of my take-home pay go to my mortgage payment. I mean, do you expect any degree of awareness on the part of clients when they come to see you? I mean, I just to say I want a $300,000 home. Well, it's not that simple. And the person looking for the loan can do a little bit of the homework, can't they?
Get off my lawn, Jay. What are you doing on my lawn?
I'm almost 70. Come on. I'm qualified.
Go ahead, Angela.
I think the biggest problem is we have information overload. We have AI now. And the biggest problem where there's no results there's no results gathered because the right questions aren't being asked. You don't know what questions to ask. So that's why I do multiple consultations throughout the experience. We're doing a 15-minute get to know you We're doing a 30-minute review, and then we're doing it again towards closing to make sure
Excellent.
you're okay with everything before you sit and sign, because you don't know what questions to ask if you don't know. So
Excellent.
I'm a huge advocate for creating a real estate team that you trust to advise you. You can't just look on, if you can't find that person online and you can't find reviews and you can't find something of value about that person, keep looking. Keep looking. So it's there's so as far as 25% ratio, of your income going towards your payment, those are things that I will tell people. On average, that's what the idea is, but it's not actually what we're seeing in the market right now. Those percentages are much higher.
I am going to jump back in here for a second and say we are a nation of wanters of immediate gratification. And
Bingo.
we don't care if we're supposed to know that 25% of our net is going to cover our debt load. What we care about is that somebody tells us it's okay. There is still that mindset that if a lender says it's okay, that must mean that we can afford it, because logic would tell you the lender doesn't want us to fail. But you know what? The lender doesn't care in most cases, because that loan sits in their house while they do their application, and 24 hours later, it's off on the secondary market. They don't care. They care about writing the apps. So if you're thinking that your banker is telling you it's going to be okay, and they've got your vision in mind for the next 10 years while you send your kids to school and buy cars and take vacations, think again. It is your responsibility to learn what you can afford and why you can afford it. And you can save yourself from enormous headaches if you just hire or go to some smart people who know what they're talking about and let them do their job. Okay? Just pay attention to what they tell you. You don't have to agree with everything, but gather some knowledge from some real humans who have real experience about this. I just want to thank Angela and Mike Tourville again
Thank you both.
for coming on from Annie Mac Mortgage, and mention that they're part of the Momentum Group. And I will put their information up so that you can reach them, of course.
Well, this is Financial Fitness, as you know, and it's always worthy information every single week. Frances, can you give the phone number again if people have questions for you?
Sure, of course, Jay. They can reach us at 413-773-3333.
Or as always, go to hugyourmoney.com. Angela and Mike, thank you very much.
Thank
You
you.
guys.
Next time around with Financial Fitness with the Money Doctor. This is Financial Fitness on WHMP.